End of the Road for Black Money in India by C.A. Anil K. Jain, author of Handbook on Macroeconomics of India, Bharat, The Development Dilemma. Introduction. The parallel economy that holds India back. One of the most persistent challenges to India's fiscal transparency and inclusive growth is the existence of a parallel economy, commonly referred to as the black money economy. For over 7 decades, successive governments have targeted this menace through legislative reforms and policy interventions, ranging from voluntary disclosure schemes under the Income Tax Act, 1961, VDS 1965, 1975, and 1997, to major structural moves like Demonetization, 2016, and the Black Money, Undisclosed Foreign Income and Assets, and Imposition of Tax Act, 2015. Yet, despite these initiatives, unaccounted money continues to permeate the system, eroding the integrity of India's fiscal framework. In my book, Bharat, The Development Dilemma, I have analyzed the institutional bottlenecks that perpetuate this issue. Among these, 2 particular policy instruments under current law continue to indirectly nourish the black economy. 1. Section 68 of the Income Tax Act, 1961, and 2. District Level Committee, DLC, rate system for property valuation under the Indian Stamp Act, 1899, and state amendments thereto. Both mechanisms, although introduced with regulatory intent, have become structurally counterproductive. Section 68, misapplication of a legitimate provision. Section 68 of the Income Tax Act, 1961, empowers the assessing officer, AO, to treat any unexplained credit in the books of an assessee as taxable income for a given financial year. The legislative intent behind this section, as interpreted by courts in CIT v. P. Mohanakala, 2007, 291, ITR 278, SC, was to target unexplained or fictitious credits that reflect actual evasion. However, in practice, Section 68 has become a tool for administrative overreach. Taxpayers frequently face additions for procedural lapses, non-traceable creditors, or minor documentation errors, even where transactions are genuine and substantiated through banking channels. Such interpretation contravenes the principles of natural justice under Article 265 of the Constitution of India, which mandates that no tax shall be levied or collected except by authority of law. This has given rise to what can be termed tax terrorism, where uncertainty and fear of discretionary assessment discourage voluntary compliance. Assessing officers, driven by revenue pressure, often blur the lines between civil assessment and criminal investigation. The CBDT Instruction No. 2, 2019, and the Faceless Assessment Scheme under Section 144B were designed to minimize such discretion. Yet on ground, arbitrary additions under Section 68 continue to generate enormous litigation. These cases clog the Income Tax Appellate Tribunal, ITAT, and high courts, shifting administrative resources from genuine investigation to procedural battles. A redefined Section 68 should require clear linkage between credit and fraudulent intent before addition, mandate prior approval from superior officers for high-value additions, exclude bona fide trade and capital receipts supported by bank records. Revenue officers must act as facilitators of compliance, not as dual-function investigators usurping the role of enforcement agencies under other statutes, such as the Prevention of Money Laundering Act, 2002, PMLA, or the Indian Penal Code, 1860. DLC rate mechanism, a structural enabler of the black economy. Under the Indian Stamp Act, 1899, each state government notifies minimum value rates for property registration through a district-level committee, DLC mechanism. These rates are meant to ensure that stamp duty is not evaded through undervaluation. However, the practical effect has been the opposite. In most jurisdictions, DLC rates lag far below prevailing market prices, sometimes by 30–70%. Consequently, transactions are registered at the official DLC value, while the balance consideration is exchanged in cash, creating a legitimate facade for unaccounted money. Sections 50C and 56(2)(x) of the Income Tax Act compound this distortion by deeming the stamp duty value as the transaction value for computing capital gains and income from other sources. Where the actual market value exceeds the DLC rate, parties often understate the sale consideration to avoid higher taxation, thereby institutionalizing the cash component. The impact of this misalignment includes artificial inflation of real estate markets and speculative asset holding, legalized routes for converting unaccounted income into immovable property, distortion of asset valuation in balance sheets, thereby weakening creditworthiness, inequitable taxation of compliant taxpayers vis-à-vis habitual evaders. This situation particularly affects transactions in agricultural land, where DLC anomalies are widest, and where capital gains remain outside the tax net under Section 2(16). 3. The resultant cash inflows enter circulation without traceability under the Income Tax Act, perpetuating the black money cycle. The reform imperative, legal and administrative alignment. For any meaningful reform, two complementary actions are essential. A calibrated overhaul of Section 68. Clear statutory definition of unexplained to avoid interpretational abuse. Introduction of graded penalty structure tied to intent and materiality. Integration with modern data analytics through AIS and pan-linked reporting to replace human suspicion with digital verification. Rationalization of DLC valuation framework. States must update DLC rates semi-annually using digital market data from registered transactions. Empower local sub-registrars to refer undervalued transactions under Section 47A of the Indian Stamp Act for fair market verification. Align DLC rates with fair market value as determined by registered valuer databases under Rule 11 UA of the Income Tax Rules, 1962. Interlink property registration data with the Income Tax AIS and GSTN to flag mismatched cash flows. Such alignment would reduce litigation, enhance voluntary compliance, and substantially eliminate the scope for converting cash into assets. Conclusion: legislative precision, not policing India's war against black money, cannot be won through episodic drives or moral rhetoric. It demands statutory precision, administrative accountability, and rational valuation frameworks. Re-examining Section 68 and DLC rate determination is not merely a matter of convenience. It is an economic necessity. By eliminating the legal ambiguities that sustain the informal economy, India can strengthen revenue integrity without coercion. The true end of black money will come not through fear but through fairness, where laws promote transparency, compliance, and trust between the taxpayer and the state. Only then can Bharat truly progress toward a formal, transparent, and equitable economy.